Hey everyone, welcome back to Corporate Decoder. Today we are diving into a company that was almost kicked off the stock exchange but managed to pull through. I know, cliffhangers like this are the best, right? We are looking at a report from Aptevo Therapeutics, a company that focuses on creating new cancer treatments. The big news, they were in danger of being delisted from the Nasdaq stock market, but they have now managed to meet the requirements to stay listed. Before we get into the details, if you find value in understanding these corporate reports, hit that subscribe button and join our Discord community linked in the description below for deeper discussions. This report is dated July 1, 2025. This is when Aptevo officially announced they were back in good standing with Nasdaq. So what was the problem? Nasdaq has rules about the minimum amount of money a company needs to have in stockholders' equity, basically the net value of the company's assets to stay listed. This is called Rule 555 and fixed Victi 1 and requires a minimum of $2.5 million. Aptevo fell below that threshold. The good news is that on July 1, 2025, Aptevo got a letter from Nasdaq confirming that they are now compliant with this rule again. It means they've managed to get their finances back on track enough to meet Nasdaq's minimum requirements. How did they do it? In a report filed in June, Aptevo said they raised about $15.9 million by selling more stock. This influx of cash helped them boost their stockholders' equity above the $2.5 million minimum. To clarify, they added approximately $15.9 million by selling shares. This increased their equity, allowing them to achieve compliance with the rule. Aptevo's stock is traded on the Nasdaq stock market under the ticker symbol APVR, and this particular filing relates to people holding common stock. So what does all this mean? Aptevo was in a tough spot, risking being delisted, which can scare investors and make it harder for a company to raise money in the future. The fact that they managed to raise additional capital and get back into compliance is a positive sign. However, it is important to remember that they needed to sell more stock to achieve this, which dilutes the value of existing shares. Diluting existing shares means each share of the company is now worth a smaller percentage of the company overall. So while it is good that Aptevo has solved its listing problem, there's potentially also a downside for current shareholders. Looking at Aptevo, it's clear they managed to navigate a critical challenge. Keeping the Nasdaq listing is a big win and shows they can take action when needed. However, potential investors should keep a close eye on how they manage their money going forward. Relying on selling stock to stay afloat isn't always sustainable in the long run. They need to demonstrate they can grow their core business and become consistently profitable. What do you think about Aptevo's situation? Are they a promising investment opportunity, or do the financial challenges raise too many red flags? Leave your thoughts in the comments below. If you found this breakdown helpful, give us a like and subscribe for more in-depth analyses of corporate filings. And don't forget to join our Discord community in the description for even more discussions. Thanks for watching, and I'll see you in the next video.